Welcome back, everyone, to another episode of Money Tree Podcast. This week we have my very good friend, Doug Heagren. Hey, Doug.
Good morning, Kirk. But where I'm at least for another minute. Hope you're doing well out there on the East Coast.
I am. We just had a good bit of snow yesterday, and it feels like the only snow we've had all winter. And I'm actually excited that my winter pool might turn into a hockey rink over the next few days. So, cross your fingers for me.
But Kelly will appreciate this. So they were thinking we were going to get Snowmageddon, and it ended up being Snowmageddon in a lot of places. But we still ended up getting third most snowfall in Minneapolis history down in Apple Valley. They got over 20 inches the other day. But it was like, but the airport, they only got like 13 or 14. So it was really hit or miss. But yeah, I know that you're appreciating the only white thing you're looking at is the sands outside your door. So.
Well, the sea foam is white too, Doug. I'm sorry, but
Till it browns up a bit.
That's just in New England, Doug.
Yeah, not here.
Right. Or Galveston. Yeah.
I'm in Florida, and it's beautiful here.
Yeah. Well, it depends the parts of Florida, but I tell you, there are some beautiful beaches. Are you up in that Emerald Coast?
I'm in Fort Lauderdale.
That's a great place.
Yeah. Nice to be here. Thanks for inviting me again. Appreciate it.
Awesome. Well, welcome back. So we also have our very own Kelly Coughlin. Hey, Kelly. How's it going?
That'd be me.
Good. Well, we're going to start this week with a tax tip of the week. So go ahead, Kelly. Give us your
All right. Well,
give us your wisdom.
I'm going to use a little more sophisticated graphic than my white paddle. All right.
There we go. All right.
Okay. So 5 tips to resolve IRS letters. I think the very first tip I gave was don't file too early. And for those that file too early, typically it's because the result is a W-2 comes in, 1099 comes in, your broker's late, there's some document that comes in later, and then ultimately you get a letter from the IRS. That's one thing. It could be unreported income. It could be a 1095A health insurance thing. Something, right? The IRS has like 5,000 types of letters, and that's just federal, right? States have their own. So it's highly likely that a taxpayer gets a letter asking for something. So here are my 5 tips to resolve IRS letters. Typically, I'll get calls. They'll say, oh my God, I got an IRS letter. I'm being audited. Most likely, you're not being audited. You will know if you're being audited, by the way. It's a much thicker letter than just a 1 or 2 or 3 page thing. So 5 tips to resolve it. Number 1, don't panic. Don't worry about it. Do 5 things. 1, check your identity. This is an easy thing. Doug, Kirk, you get a letter, look at it to make sure your name is there and your social security number. I think you smart guys could figure that one out. Do you agree?
I think so. Yes.
Absolutely. I've had them. I've seen them. I know what you're talking about.
It's important. Sometimes the IRS messes up. Just make sure it's you, right? Number 2, the tax year. This will be on the upper right normally. Depends on the letter, but generally it's the upper right. So you note what tax year are you talking about. So if you have to call your accountant or you have to call the IRS, God forbid, the first thing they'll ask, who are you? What year are we talking about? Right? So believe it or not, I'll be in a discussion with somebody, and if I forget to ask the question, I assume we're talking about like 2021, and they say, "Oh no, did I tell you this is like 2013 letter?" Right? It's very important, right? Tax year. 3rd, notice type. Right? There'll be a notice ID on there. CP 2000 is one that a lot of people get. Tends to be unreported income. Let's say all the wealthy viewers of yours, Kirk, that forgot to report a broker statement, some security sales, right? That's a common one, right? They had another trading account. Oh God, I forgot to report that one. CP 2000 comes in, says, hey, we saw a broker that reported you sold $100,000 in securities. We don't see, they really just match on sales. Number 1, we talked about this on another one, is make sure your sales proceeds matches what your brokers report. Absolutely, it can match. If it doesn't match, you're going to get a letter. So make sure the sales proceeds matches. So that letter comes in, CP 2000, notice type. Then the final two is what was the purpose? Was it stock sale? Was it unreported dividends, interest? Then you get into the resolution. What happened here? Did you fail to report income? It's no big deal. Again, this is not a crime. This is not an audit. They have a mismatch of what the IRS expected from reporting companies, banks, financial institutions, others that reported certain thing. The IRS expected that to come through in your tax return. There's a mismatch. What are you going to do to resolve it? If you need help, then you outreach to your CPA or somebody. If you need help, chances are you can resolve this. If you didn't report interest from a broker, did you get the interest? Was that accurate? Oh, darn, I forgot. IRS will do the calculation, send the money. That's it. Now, if it's a significant number, sometimes you'll get penalties and you got to pay those penalties. It's hard to get those things waived. You can't complain to the IRS and say, oh, the bank sent it to me late and I filed the tax return, or I didn't know that I never got it in the mail. That stuff doesn't work. The IRS says, you know what, you got a broker account. You should know what you did. I don't know if that's reasonable or not, but that's it. 5 tips. Identify yourself, tax year, type of notice. What was the purpose of the notice, and what are you going to do to resolve it? That's it for me.
Awesome. Well, I love it, Kelly. I know we get tons of calls, maybe not tons, but we get a few each year. Somebody gets a letter for something silly, like they rolled over their 401k into an IRA, and the IRS sends them a letter and they freak out and they call, oh my God, the world's going to end. I'm getting audited.
Yeah.
What did I do wrong? And I think what it sounds like you're saying is, nope, don't worry about it. Just talk to your accountant and they'll take care of it for you.
Yeah, get it resolved. Don't stick it in the file because it just grows. I look at it like this. It's like a clogged toilet. It doesn't get any better with age. It's not like good red wine. Right?
Look, and Kelly, I want to add something for a lot of people to get these, because I've been through a couple of these situations for various reasons. The one thing the IRS will always assume, if they think that there's something wrong, they're always going to assume you're going to owe them the maximum amount of tax possible, right? So a lot of times on those statements, they'll say, you owe us right now $100,000. You're like, whoa, $100,000. Why? Well, because you sold the stock for $100,000, and they're assuming 100% of that sale, it's got to be their tax, and it's up to you to show, no, wait a second, there was a cost basis. So they're always, a lot of times those numbers on there can be very scary, but have very little to do with what the true amount is. So again, I think what you're trying to say, Kelly, is if you get one of these notices, take a breather, maybe get yourself a scotch, take a sip, call your CPA or tax advisor, work through it, but don't panic.
Yeah, it's a fair point. What they do is rightfully, they'll overstate the liability to get your attention, right? And they'll also say, you need to resolve this in 30 days. Or, yeah, that's good. It's always good to, if you can't get it resolved in 30 days, send them a letter, put it in the mail. You don't need to send it certified. Just take a picture of it, send it in the mail, say, I need 30 more days, that kind of thing. It's okay. They're used to people just blowing it off, right? And so don't be that person. Don't just blow it off, right? You got plenty of time to work it out.
Yeah, I'm pretty sure you don't have 30 days, especially since it might take you 30 days to get somebody on the phone in the IRS right now.
You got that.
But no worries, because I got 85,000 new agents coming in to help you.
With guns, just in case.
Well, I love to help people. I've got a special number I can jump the queue so I can get it if I need to call, but I charge for it, right? If I need to call IRS and help them get it resolved, I can jump the queue and get it done. But there's no way in hell I'd wait online with that. I mean, if you do want to call at 7 a.m, East Coast time, get up, make the call early. That's a better time, but try everything in your power to not have to call them on the phone.
Yeah, that's great advice. Well, I appreciate your insight this week, Kelly. I know you're busy doing taxes, but we'll keep having you back on through tax season, because I know you're going to have a lot of great new tips, and appreciate you sharing your wisdom.
Okay, boys, take care. Thanks.
Great. Thanks,
Bye.
Kelly.
All right. So we got lots to talk about this week, Doug. We got lots of visuals here, and certainly we had the PCE number come out today, which was higher than normal. And I'll let you talk about it, but just for reference, the PCE number is actually it's another inflation number, but it's what the Fed likes to look at. It's their preferred measure, and they were expecting a 0.4% increase. It was a 0.6. You might think, well, that's not a lot. But the market expects something and something different happens, the market tends to react accordingly. So, and as of today, it's Friday. The market did not like that, not one bit. So, Doug, why don't you tell us a little bit about the PCE and what people should be worried about or not with this number?
Well, so the PCE, I mean, the CPI and the PCE are the two main price indexes used to measure inflation. Okay. Now, the Consumer Price Index is distributed by the Bureau of Labor Statistics, and the PCE, which is Personal Consumption Expenditure Price Index, is distributed by the Bureau of the Economic Analysis. I mean, if we didn't think there was a little too much going on in our government, there's an example right there that we don't even have one group that's coming up with these numbers. And the Federal Reserve actually prefers to use the PCE. So remember, we talked about in the past conversations last week or the week before that the CPE came out, and there was kind of a little bit, the media was all over it and really loving the information there. Federal Reserve does monitor the CPI as well, but guess what? Markets didn't do a lot, Kirk, after the PCE came or the CPI came out. Why? Because the Federal Reserve doesn't really look at that too much. Historically, they don't really deviate by large margins, but in 2022, this changed quite a bit. As of second quarter of 2022, the quarter-over-quarter change in the CPI was a full 3.4 percentage points above the same period change in CPE. So again, that's the highest difference on record. So why do they deviate at all? What causes those indexes? There's actually more than I'm going to get into here. There's formulaic, there's scope, there's weight, there's other. But the difference is, and the consequential in terms of overall effect, is that because it can have a domino effect on other differences, such as relative weighting, how consumers are spending their money, what they're spending their money on, healthcare insurance providers versus prescription drugs. So, I mean, in what basically the key is, without getting too technical in the weeds here, is that the CPI numbers, while there was a lot of spin, that they weren't as bad as they were getting better. And we talked about that last week, that they weren't as good as people thought, and that, yeah, we're still high year over year. Unfortunately, Kirk, the PCE number came in at a level in which, once again, the Fed feels very justified that we've got significant inflationary problems, more than they were thinking that we were going to be facing. And of course, that's why, if you're looking at the markets today, you're seeing a little bit of a backlash and reaction, because this is going to potentially lead to a continual, we should have seen this coming, Kirk, because we've been talking about this, focus by the Fed to do whatever they can to tamper down inflation. And while, again, people have been talking about, a quarter point increase of interest rates over the next two Federal Reserve meetings, now there's fear that that's going to be higher. Could be a half point, could be 3/4 point. We don't know yet. But again, what is the number one thing Wall Street doesn't like, Kirk? Uncertainty. And welcome, it's back.
That's for sure, Doug. Well, appreciate your giving us some insight into that. I think, I don't typically look at the PC. I typically look at the CPI, and frankly, it doesn't matter. You can look at one or the other. The way I kind of look at statistics is close enough is good enough, right? Because you could argue whether, we talked about the CPI before, should real estate be 42 or 45? I don't know. I don't care, right? We're looking for trends. We're looking for direction. So if you're looking at like a CPI, it was like, it's more housing and it's going to impact it. Yeah, it probably will. But where's the direction? Is the direction still up? Is it generally within the same path, right? Because we talk about this a lot in the show, right? If you think about, what's going on, we had inflation. It peaked mid last year. I think around July last year, inflation peaked at 9.1, I think it was, or something like that %. And now the CPI is down to 6.5. And, if you look at those numbers and say, is it 6.5 or 6.4 or 6.6? I don't really care, right? What I care about is directionally, where is it going, right? And is it directionally going in the way we think it is? Now, when I look at a measure like today, and I'm kind of laughing as we were talking about, like, oh, the markets don't look good today. And as I'm looking at the markets, I think the only thing that's actually up today is the U.S. dollar, and I think there's one stock in there. It's an oil stock, and there's basically nothing's up. Stocks, bonds, everything's down. And so when we're looking at investing, right, we talk about this a lot in the show, and I think people get confused. We get a lot of love mail, we get a lot of hate mail, and I always like to talk to the hate mail because people say, well, you're talking out both sides of your mouth. Well, no, I'm not. I'm trying to clearly explain where I'm coming from, which is you can have both outcomes. You read a lot of, I know a lot of people read newsletters and they're like, well, this person said this and this person said that. Okay, they're probably trying to rile up your fear part of your brain to get you all freaked out. So you follow them more, and then you say, well, I got to follow this person because if I don't, I'm not going to know what's going on. Now, for those of you who follow like a CNBC or a newsletter or pretty much any major media TV, right? If you follow any of it and you watch it and you feel like, oh my God, I need to know what's going on. I need to log in, or I need to watch. If you take a week off, it's kind of like an exercise in mindfulness. You take a week off from watching media, news, any kind of news, and get your head out of social media for a week. What you'll find when you come back is going to be really apparent to you how manipulated you are. And it's done deliberately, right? It's done to get you to subscribe, to get you to tune in, all of this. Everyone does it. It's not like, oh, Fox does it or CNN does it. They all do it because they have to, right? Their job is to get you to watch, and they sell advertising to you. That's how they make money. So while I don't like it, I also understand it because that's their job. So what you need to do is you need to understand it. You need to understand that you're being manipulated by all these different people so that you'll tune in, which is why we don't go down that road, why we don't sell fear here. What we're trying to do is we're trying to educate you on how to think about investing. And this is a mental framework that'll help you think about investing.
I know you love the show. I do get a lot of love mail and hate mail from people who listen to the show. I certainly prefer the former, but I have a thick skin if you want to send the latter. However, I do need to ask you a favor. We're looking to expand the show with a lot more resources and high-end guests. You're going to love what we have in store for you in the upcoming months. However, now I need your help. I need 5 to 10 minutes of your time to help influence the direction of the show. We're doing our annual listener survey to help understand our audience better. I know you're busy with your life. Well, I am too. My kids are going back to school, and that leaves me less time for other things. But as a listener of the show, I could really use your feedback. I'm not the government, so I'm not asking you to work for free. So in exchange for 5 or 10 minutes of your time, I'm going to give you a gift of over 100 million Zim dollars. That's right. I'm giving you a gift of over 100 million Zim dollars in exchange for 5 to 10 minutes of your time. Go to moneytreepodcast.com/free money to get your free money today.
And we're going to talk about a bunch of things today, but I wanted to start with that, and I actually wanted to show one chart here, which I kind of laughed at when I saw, and I figured, yeah, that's pretty accurate as I think about it. But the chart here is the distrust of news and media is more common than ever before. Now, I wanted to show this. Here we go. So I wanted to show this because you're going to look at it and say, wow, people used to trust newspapers and the TV news, and now they don't trust it. Now, somebody out there, and I'm sure, we got a lot of comments on LinkedIn and YouTube, which is, where we're live. So if you're on those, please go and give your questions because we always love addressing them. But if you look at this, someone's going to draw the conclusion, well, it's because a certain person was elected to office. Well, I don't know. If you look at the trend, I think anybody elected to office pretty much fills this gap. So, we hit a low of 2023. The invasion of Iraq was around 18%. And now we're around, depending on newspapers or news, it's somewhere between 46 and 53%. So what I find interesting is approximately half of the country distrusts the media. And Doug, you want to take a guess which half distrusts and which half doesn't?
I don't know, Kirk. Tell me. I'm going to guess that the which half distrust the media. I'm going to guess that that's going to be more the right.
I would actually, so that's a good guess, and I
Okay.
think that we've seen that. But
Yeah.
I'm gonna have a different theory, and I'm throwing
Okay.
this out there to get people to think outside the box. I'm gonna suggest it's the 50% that's not in power. So if you're a Democrat and a Democrat's in power, you trust the media because they're telling you what you want to hear. If you're a Republican, you don't trust it because they're telling you the opposite of what you want to hear. On the other hand, when Republicans in power, the Democrats distrust the media because, well, they're just they're steamrolling us, they're gaslighting us, they're coming out with all this stuff. Even though the media tends to tilt more towards Democrat, except for Fox, they all tend to be more Democratic leaning. Um, However, when Republicans in power, you're tending to get more. Not Trump. Trump was kind of an outlier, but when you had Bush and some other people who were traditional Republicans, you would tend to get a little bit more party lines. So I would argue that the distrust actually is 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 what the media is doing to us and has started to do in the last 20 years has been a making of their own device. So they've caused this because they're trying to get better ratings. So people mistrust them because they deserve it, frankly. Um, I watch the news and frankly, I don't see any news. What I see is a lot of fear being disseminated out to freak people out so they watch. I don't watch. I haven't watched the news in over 20 years, and I haven't missed a thing. I am
Kirk,
probably as well informed or more so than most people, and I don't watch TV. I don't watch the news, and I don't miss anything. Go ahead, Doug.
well, I was going to say, Kirk, I wasn't sure. I just want to know if this chart was published before or after CNN went from being loathed by the right to having no identity whatsoever, being loathed by everybody. I'm just not sure which chart, as they changed and flip flopped their entire format and made nobody happy over the last year or two. So just curious what the timing of this chart was.
So I think this is a relatively recent chart. If you look at it, it goes up till the end of last year, but. It's actually an interesting point when you mentioned about CNN. I like the idea of them trying to, basically be in the middle because I think that is an admirable goal, and I think every news station should do that. That's the way it used to be, 40 years ago.
It's the way they used to be. CNN at one point was a very good source of information that seemed to kind of really stray down the middle road and give the news.
Right. And then they turned, as a friend of mine said, they turned into the CNN stood for the Clinton News Network. And then Fox turned to the right, and then everyone kind of they split upon party lines because that's what people wanted to hear. And this gets into the concept of the echo chamber, right? Is we all want echo chambers. We want to find opinions that reflect our own. And this is human nature, by the way. This is tribalism, right? We all want to find groups of people that reflect us, that reflect our values, they reflect our identities, right? We all have an identity, and the identity is just something we conceive of ourselves. It's not necessarily true or false. It's just how we see ourselves, right? And so we want to find people that identify with how we identify, whether it's a Democrat, a Republican, whether it's religious, non-religious, whatever, however you identify. And then people who reflect our values and people who reflect our political opinions. So we all kind of try to find these echo chambers. The problem with the echo chambers is they're reflecting back all the things you already, quote unquote, know about the world. The problem is it's not accurate, right? Echo chambers are not accurate. There are a bunch of people who are reflecting back on ideas that are just reinforcing your own ideas, but you don't learn anything, right? If you're a Republican and you're going to you're going to a meetup group or whatever, a group of Republicans, they're all going to be talking about the same stuff, but everyone's going to have the same opinion. So you never learn anything. You just feel good about yourself, which, is okay, right? I don't think badly of that. It's like religion, right? Like people are religious. They talk about religious concepts because they self-identify as that religion. And so they can have this conversation along with similar themes, right? Whereas someone who's non-religious might say, I don't identify that way, so I don't understand what you're saying. So I'm bringing this up because I want to talk about the concept of, as we all think we try to think outside the box, but we really don't, right? We're in echo chambers, and we're not really. It's hard to think outside the box because your ideas are basically given to you. They're given to you by your group. They're given to you by the media that you follow. They're given to you by what you read. So most people don't have original ideas. Now I know our listeners are pretty smart. We have a smart bunch of listeners, and they're probably all thinking, "Yeah, I don't do that." No, we all do it, myself included. You can't. It's really hard to escape it, right? And you have to be. This has to be your primary focus, to do nothing but this, because every part of your life is going to have this. And you can't actively think about everything in your life or your brain would explode. That's why we have habits. That's why your brain has automation that happens, right? Like think about it, like you drive to work one day and you get there and you're like, wait a minute, how did I get here? Right? You just, whatever, in the morning you're tired and you're just like, holy crap, how did I get to work? I don't remember anything. That's your brain automating the road to work because you do it every day and it's a habit. Your brain does that because it needs to free up space to do other things. So we all automate things. But getting back to the point of this echo chamber, we all should seek out opinions from the other side. And I know that some of you are going to be like, oh, the other side, they're a bunch of idiots, they're evil, or they're stupid. Well, you know what they think about you? They think the same thing. They all think that you're evil, stupid, or misinformed. They think the same thing, right? And the reason is because everybody's on their partisan lines or their side, and no one's in the, or very few people are in the middle, or there are very few people are trying to go to the other side that really understand the other side. They just want to yell and scream and tell them they're wrong, rather than saying, help me understand your point of view, and let's try to disagree without being disagreeable. And that's really hard to do. But I challenge everybody listening to the show to do that, because that's how you learn. You want to learn from the other side, because maybe your side is right, maybe they're wrong. But if you go to the other side and you say, all right, explain to me how you're thinking about this, you might learn something and say, wow, I thought about that thing wrong. And maybe this is a better way to think about it. And it'll help formulate your view in the world, and it'll help give you a template on how to make better decisions. So in the market, as in life, you want to know and I'm getting a little deep in the weeds here, and I'll pull it back to something a little more fun, but I really want to get into this because to me this is fascinating. Is what is the best predictor of truth? If you want to know if your lens on the world, right? We all have a lens. We all see the world through a certain set of eyes, a certain set of values and views on the world, right? Each one of us is different. Doug and I agree on a lot of things, but we're also different on some things. So we have a different lens. We all have a unique lens. Now, the best predictor of truth, right? You want to know if you know the truth or reality, as it were. It's how good are you at predicting the future? That is the best predictor of reality, is can you tell the future? Now, none of us can tell the future, which means we really don't have a view on reality. And I say this because we all have to be really humble about our opinions, because we all think, oh, this is going to happen. The stock market's going to go down. It's going to go up, right? It's going to be sunny out. This person's going to win. We all have this lens on the world that is an absolute lens of this way is the right way, but it's not. It's our view. And everyone has their own views, and they all, some of them overlap and some of them conflict at times. But we don't have there's no single truth. There might be, but none of us are able to see it. The best way to see it is to get different perspectives and say, all right, this makes more sense than what I was thinking. How can I integrate this into my life so that I have a better lens on the world and a better predictive value in terms of where things are going? Now, none of us are going to be able to predict the markets because there's a bunch of things that we're never going to be able to know. We can assume, we can make thesis, but we all have to be adaptable to know, like, here's my thesis. I think that, for instance, we talk about it in the show. I've been talking about it for years that we're going to have high inflation. And now I'm claiming that we're going to have deflation, which is freaking people out. And we're getting more hate mail than we've ever gotten because they're saying, how can we have deflation? But my point is that, the thesis is, yes, we're going to have deflation, but it's not as if prices are going to go down. It's that based on statistical values, we could see a negative CPI print. It doesn't mean we're going to have deflation. It just means that due to statistics, that could happen by the end of the year. Now, I still think inflation is going to come off. I do think it's also going to go back up at a later time. So what do you take from that? I just said it's going to go up and down. So what do you take from that? Well, here's what you take from that. they're going to be on different time frames. I'm not saying they're going to do both so I can be right. I'm saying that they're going to do both because they're going to happen on different time frames. So how would you perceive that? Well, the way to perceive it is you have to be agile in your thinking. You have to be nimble with your portfolio. If you're buying a bunch of illiquid assets like real estate and rental property, you could be over the barrel really quick because you're not going to be able to move. If inflation goes up 10, 15, 20%, you're going to be screwed. And so I make these points to show you that you can have both things and two things could happen at different time frames, but they will affect you in a very similar way. And my solution to this is you have to be nimble. So think about your portfolio and how you can be more nimble, knowing that both outcomes can happen. And that could also, but the outcome is this. It's going to be mass confusion. This is what happened in the 70s, is there was mass confusion. Nobody knew it was happening. They didn't know how to predict it. They didn't know what was going to happen next. And what did we see? The markets went up and down a lot, but basically went sideways. That was mass confusion. We're going to see more of that. That's the takeaway you should have, is mass confusion means you can't predict it. It's even harder to predict. So what do? You think about, all right, what are the things I can feel comfortable with and focus on that. Liquidity is really important. There will be plenty of opportunities in the next 10 years, a lot of opportunities. They just might not be today. So you need to have patience. You need to be really focused on risk management, focused on patience and agility. So that's what I want to leave you with this. And then I want to go into some different topics and I'll let Doug talk about them because I've been doing too much talking here. So let me dig into these few parts, and we're going to talk about real estate now, Doug. I know that's your favorite topic. So let's start with let's start with this one. So here's a chart of the United States, and I'm going to explain it. I'm going to let Doug get into it, and then we're going to talk about a bunch of these charts. So this is a chart of the United States. For those of you who are listening to the audio, please go to our website. You'll see all the charts. You can go to YouTube. You can watch this live. Or every Friday, you can come watch the show live on LinkedIn Live at 1 o'clock every Friday. We also are on YouTube Live, 1 o'clock every Friday Eastern Standard Time. And all right, so now this is a chart of the United States. Every state has a different color. Now, the explanation of this is what this is showing is basically your monthly interest payments as a percentage of median income, meaning that if your monthly interest payments are $1,000 and median income is $2,000, then the percentage would be 50%, just as an explanation. If the median income is $3,000 and the interest payments are $1,000, then the percentage would be 33%. So standard is typically 30, is what banks want to see, is 30%. Doesn't always happen, but that's what they like to see. So blue is lower, red is higher. So why don't you take it from here, Doug?
Well, first of all, let's give some just to give some credit where credit's due. A lot of the data we're going to talk about that coming up here, that I'm going to go over here, including the chart you're showing, comes from Reventure. So a fantastic follow, really good insights. I've mentioned before that from the the auto side of things, I'm a big fan of Car Dealership Guy on Twitter. Great information. Look, we're looking for logic. We're looking for data. Okay. And so basically what's happening here is that there has been a fundamental shift over the last 24 months in real estate. And unfortunately, the reality is that, good things don't last. And the other side of it is that, unfortunately, it's very hard for some people to accept reality. So what we're looking at with this chart here, and kind of to jump around, is, as you mentioned, this is the house payment to median income percentage. And as you can see, if we look at red being much more house payment to the income available versus blue being a much lower payment based on the income, you can see a pattern here, Kirk, that there is a big problem out west. As a matter of fact, California is looking at around an average house payment as a percentage of median income of 65.8%. A typical yearly house payment there is $58,000 a year. That's typical, with a median household income of only $88,000. As much as we like to think California's got all this money in Silicon Valley, the reality is a lot of people that live in California that don't make that kind of money. Okay. And now if we take a look at, alternately to a place like Iowa, Well, actually, let's stay on the West Coast, for example. If you look at Washington is a 54.55% house payment as a median as a percentage of median income, with a typical annual housing payment of $47,000 to $48,000 there. But again, you're still looking at a median household income of $86,000 a year. So right on par with California, but still way too expensive for people to buy. Now you look at a place like Iowa. Iowa is a great example of where you're seeing the opposite. It is below that average. They're actually showing in Iowa about 24.75% as a percentage of median income. So, in Iowa, the average you're going to pay for housing, and this is to buy a house, is only $17,000 a year. That's a little bit over $1,000 a month for housing there, on a median income there of about $68,000, $69,000. So $20,000 a year less median income, but you're looking at like $30,000 to $40,000 less in home payments. So what do we have? Is we have a situation where we're starting to see a correlation, a very sizable correlation of a drop in the amount of investment activity that is happening in those markets. As a matter of fact, if we go and we look at metros of the largest declines of investor home purchases for Q4 2022, Vegas, Phoenix, there's Jacksonville, Florida, there's Charlotte, North Carolina, Atlanta, Georgia. You're looking at, on the average, somewhere around 50 to 67% investor purchases change year to year. The investors are gone. They're leaving because they're not going to overpay. They're running out of money. There's been a 46% decline year over year in the number of homes bought by investors. But there's a double whammy on this, because unfortunately what's happening is they're pulling out of markets where there's clearly way too expensive pricing for housing. They don't have the money to continue to buy these. And what's also going to potentially occur is that as they run into additional liquidity sources, because they're running out of money, the mortgage-backed security purchases dropped significantly between Q1 2022 and Q1 2023. And by that lack of mortgage-backed security purchases, basically, they don't have the money anymore. They don't have the money to go out and acquire all of this real estate. But there's two problems. Not only can they not acquire it, they also have to be able to hold on to it. And so that lack of liquidity is also meaning that they're going to start to potentially sell off the inventory of them in those markets. So now they start to have this this pricing pressure for those that are living there. Of what you're going to see is, again, above what you hear is that we have supply and demand. We always need houses. Well, guess what? In those markets, you're seeing an oversupply, and you're going to see a significant collapse going on there. But you're also simultaneously seeing and leaving in those markets only home buyers, the ones that we want to have. And we saw a little bit of a spike that it was going on, basically through the end of last year, early this year, of home buyers starting to buy and take out mortgages. That has eroded again. So not only people that are going to be left in some of these markets are going to be home buyers who aren't buying the homes either, because they can't afford it. The housing prices are still significantly too high. And if you look at kind of where housing prices have gone, home prices from 1960 to 2022, inflation adjusted, we have exceeded the peak of what those housing prices cost in 2008, before the crash. Okay. And we're starting to see it come down. And the biggest issue is people have a belief that we're going to potentially see this turnaround quickly. Now, that may or may not, but general housing cycles are about 15 years. Okay. So if that's the case, and it takes, a number of years to have things reset, this may be something that isn't necessarily going to reverse itself quickly. And now, of course, you may be hearing, hey, there's lots of opportunity out there. Go ahead and buy. We've already seen the dip. Don't forget that there's also the side of it that of this equation is who's selling that dip are the people that also have the most to lose. Okay. And so one of the things they were talking about, and Wall Street Journal published an article on this, home sales are slowing. Realtors that are in this business making a living are starting to see that they can, again, feast or famine. They don't have predictable minimum reoccurring revenue. They don't have a salary. You sell a home, you get paid. You don't sell a home, you don't get paid. Well, there's a lot of realtors who are now not making any money. They're starting to go back to other jobs. But until then, until they face that reality, they're going to continue to push. You need to buy now because they need you to buy. And the Realtor Association needs you to buy to uphold its its members. Okay. The number of realtors in America are 50% higher than the average, the long run average. Okay. And we are now somewhere in the range of 500,000 realtors greater than we were before the real estate crash. And I was talking to Kirk about this before the meeting. Back when we had the Great Recession, California at the time had roughly, I believe, and again, quote me directly on this, but it was something like 70% of their workforce was in real estate. Okay. And guess what was happening is we were seeing these outrageous unemployment numbers, but they weren't real. And the reason they weren't real is because so many individuals who were in industries like real estate weren't making a dime, but had yet to declare themselves unemployed. They hadn't gone and filed for unemployment. So even though the numbers were saying there was a certain level of unemployment, the true unemployment number was multiple times greater than that. And now what we're going to see is if we have a complete stall in, especially in some of the biggest markets that have the biggest return. We've all seen this. I mean, not we've all seen them. Many of you probably don't watch them, but HGTV, I know I'm married. My wife loves watching some of these shows. They used to be Fix and Flip It and all these crazy things back in the day. Guess what? They're all based in these big hot markets. Okay. And they're based on it because the housing is more expensive there. You can make a bigger, they're only getting 5 to 6% per transaction. So you're going to make it on a $5 million house, or would you rather have to go out and sell a bunch of $250,000 houses, to make up the same amount of income? Well, guess what? That ends up leading to a lot more realtors concentrated in those markets. And that also means that there's going to be potentially an even greater amount of individuals who are going to get flushed out of the market. Now, the other problem that we're seeing, and again, then I'll turn it back to you, Kirk, is that not only are the investors bailing from these high ratio markets, which then, of course, leads to greater acceleration as home buyers don't buy too, and then we get into the liquidation, but we're also seeing a double whammy. We are seeing a massive rental vacancy skyrocket coming as well. So not only are these homes not selling, but again, they're not renting. So guess what that means? Dead money on the books. It is, and again, I talk to people who want to get in real estate all the time. They always talk about the money you can make and what they call passive income. It's not passive income. You got to work really hard to get the real estate income. It's different income. It's not like going from a 9-to-5 job, but you've got to keep that house. You got to keep the upkeep. There's a lot of money that goes into maintaining it. You're going to have calls in the middle of the night, or you're going to pay someone to do property management, which is going to cut into your margins. And at the end of the day, you have to keep that house rented at a reasonable rate, or else all of a sudden it stops. And right after COVID, Kirk, you probably remember this. It wasn't a month into the shutdowns where people who owned Verbos and Airbnbs were crying mercy, claiming I'm going to have to sell this. I'm not making any money. I'm losing money left and right. Because unfortunately, in the predominant average in real estate, most people within it are highly illiquid. They do not have enough focus on keeping enough liquidity and cash. And they think, I could just go borrow against that, or I'm going to continue to get this income. And if it stops, guess what doesn't stop? Your liabilities, your upkeep, your overhead, your utilities, all of that stuff. So if all of a sudden we start to see a massive rental vacancy rate, because if we can rent these homes, Kirk, there's no purpose to necessarily go out and bail and sell them, right? Because they're doing something for you. But if you're sitting on an asset that has a tremendous cost and a tremendous lack of liquidity, and now it's not producing any income to pay for it, again, the acceleration of trying to get out of that illiquid situation, it's what leads to things like Dave Ramsey. One of the reasons he's anti-debt, guess what his background was? He went out, bought real estate, used that real estate to leverage, buy more real estate, and all of a sudden things happen, and the banks came along and said, sell. We need to get that money from you. He didn't have it. Boom, fire sale. So as we look at those, and we saw a little taste of this, right, of the Super Bowl a couple weeks ago, Phoenix was an area where so many people had rents on the market for the Super Bowl that they couldn't rent, that they were literally dropping the price of rentals from $2,500 a night and still seeing 70% vacancy for the Super Bowl down to $300 a night, and they still couldn't rent it. Now, this is not going to be something that's going to happen everywhere. I mean, you're going to see these inventories dropping, and I mean, we're seeing them in places like Ogden, Utah, Nashville, Tennessee. A lot of places in Utah are seeing massive inventory. So, that's going to be something to watch. But Austin, Texas, Florida, North Carolina, Dallas, Denver, a lot of places that we saw massive spikes in real estate pricing. We're seeing that right now it is actually still more inexpensive to rent than it is to buy in those markets. Okay. So that's, and that's going to be a behavioral shift for a lot of people, because a lot of people have always been told it's cheaper to buy than rent. And that is not the case always on a cyclical basis. Now, there are places where there's a lot of lower inventory and you can actually get really good pricing on housing. It's still cheaper to go there and rent. And again, a lot of those are in those areas that were on that initial map, Kirk, where there's a lot of, where it's kind of the Midwest. But ironically, in places like New York, there are pockets like Corning, New York as well. So you get outside of, Metro New York City, the rest of New York is a lot like the rest of the Midwest in a lot of different areas. But again, if you live in Oakland, California, or Austin, or Chicago, or Denver, I mean, you're looking at price declines, and people say they're not going to decline that much. Here's the data: 27% declines in Oakland. Karen, you were on last week. I hope you're not trying to sell anytime soon. If you're listening to us today, again, please feel free to join in. But I mean, Denver area, a place where I know plenty of people say, look, the real estate, we made so much money in real estate here. It's always going to go up. It keeps going up. We're better than other markets. Right now, between May of 2022 to January 2023, they're looking at almost a 14 to 15% decline in the price of real estate there. So, I mean, you're going to see a lot of suffering to come depending on markets you're in. There's still lots of opportunities, and you may be in areas where there's plenty of sales and transactions that are still getting bidding wars, because again, this is very geographical. But again, in a lot of the places that people want to be, Kirk, supply and demand drove those prices to outrageous levels. Investors came in and drove them even more. And now, who knows how long this is going to be, but there's going to be a little bit of a reconciliation.
Yeah, no, I agree. And I want to touch on a bunch of points here before we get close to wrapping it up. So you think about real estate, and I've had a lot of these conversations recently. So in the last few years, real estate prices got so high, and the cap rates, for those of you who don't know cap rates, just look them up. But and the cap rates got so low that people were trying to squeeze out returns, right? And a lot of people were just saying, I'll just take zero yield, zero cash flow, because it'll appreciate. I can't think of anything worse to do with an investment. That's like buying a dividend stock that's paying zero dividend and hoping it grows. It's not how things work, right? You don't buy real estate for appreciation. You buy it for cash flow. Appreciation is hopefully a positive after effect. That's not why you buy. If you buy it for that, you could be sorely disappointed, especially now. I mean, the last 40 years, you probably would have done fine. But there are times like now, and probably the next 5 to 10 years, where it's not going to be favorable. And so you're going to be disappointed if you own a home and you're getting no cash flow, because not only you have no cash flow, the price is going to decline, and eventually the cash flow is going to decline. So what a lot of people were doing in the last few years is the Airbnb. They'll buy a property, and instead of renting it for the whole year, which is what most rentals are, they're going to rent it for a day or 2 days, and they'll get a better return, a better yield. Great. If you can rent it every single day, you can get a much better return. Totally true, right? However, that's also a riskier strategy. And I think what people need to understand is the element of return that tends to go with risk. There's a reason you get a better return, because it's riskier, it requires more work, it requires more effort. And you can say, oh, it's Airbnb, they make it easy. Yeah, but it still requires work. What if a renter does something stupid? What if you can't rent it out for 3 months? There's all these questions that come into play. And if you're not on top of it, you're really going to get yourself into a bind. So I mention this because I've talked to a number of people in the last few months who have Airbnbs, and they're like, what should I do? And my answer is typically, well, if you're squeaking by now, sell, because it's still a seller's market in many areas. You can still get a good price because there's still people out there trying to buy real estate, which I think is silly, but hey, who am I to judge? Every area is different. Some areas are fine, some areas are not. Most areas are not. But I think the thing to think about is that if you're trying to squeak out extra yield by doing riskier things, when I mean riskier, I mean just, there's just more variability in it. If you rent out for a year, you can get a good renter. They could stay there for 10 years and you'll be fine, right? But if you're doing it daily, you got to negotiate every single day and whether it's a good rate or not, right? I mean, there's a lot more that goes in, a lot more risk. So while you may get a better return, there's more risk. So, when we look at real estate, we need to keep in mind that right now is not the best time to be an investor in real estate. And we kind of go back to this chart. This chart, if anything, is a good indication of what I mean, is that there are certain areas in the country which are probably more affordable based on this, right? If you just look at what it's going to cost based on the median income and then the price, the center part of the country is a little bit better. Now, that being said, we're also looking at median income, which is, it's lower. It's lower than what the median income is in California. It's a little bit skewed here, but regardless, I think the trend is still very similar. Like the theme is the same. Now, if you look at this is showing investor home purchases. Investor home purchases are falling off the table, 46% decline. Now, this is year over year. So if you look at year over year, you could argue that, well, year over year it was actually higher. So, and this is a statistical thing, right? When people look at that, they're like, wow, it's off 46%. All right, I'm going to be the contrarian on my own point, right? It's off 46%. Yes, compared to a much higher point where the prior time it was up 55%. So, all right, so it's kind of balancing itself out in many ways, right? Maybe it's going back to normal. And I'm not suggesting that it's going to stay this way forever. But I think as a trend, you need to understand that, yes, it is a lot lower than it was a year ago. It's 46% lower than it was a year ago. That is something you should take note of. But the fact that it's 46% is irrelevant because you're looking at a year ago, which it was up 55, which, like I said, it kind of balances out. And I suppose if you look at the, I don't know what year it was, but if you look at this big high point where it was up like 125%, obviously the years after that are lower. So when you're looking at statistics, you need to understand what's being measured. Now, I want to point out a few more points here. One is personal savings rate, which is as low as it's been in the last 40 years, 60 years. In the last 60 years is as low as it's ever been. So that is an indicator you all need to keep an eye on, because this is something that, let's see if I can move this. We're looking here, 2005 was a point in time where it was low savings rate as well, but this is really low. This is whatever it is, 2%, 2.5%. This means that people don't have money to pay for things they need to pay for. There's not a lot of margin for error. And I think people need to be mindful of this, because not only has the savings rate gone down, but credit card debt has gone through the roof, which means people are getting squeezed, and we're not seeing it in the data. So, if people didn't have debt, if debt didn't exist, if Dave Ramsey had his way, no one would have any debt and we'd all be happy. I'm not sure that's a good thing, but anyway, so people don't have debt. This would show you, this statistic alone would show you how much spending power people have, because the further it goes to zero, the less people have to spend. But because they have debt, they're racking up extra debt. They're doing other things. They're using home equity, whatever they're using to pay to continue the lifestyle that they're accustomed to. That's not necessarily a good thing. The lifestyles we've become accustomed to are really luxurious compared to everybody else in the world, and frankly, compared to what it should be in this country. So we've overspent by a lot. The federal government printed up a lot of money in 2020 to bail everybody out, and people went and spent it many ways on stupid things. And some people were smart about it and they paid down debt and, did other things. But a lot of people just wasted that opportunity. And now that opportunity is disappearing. And now they have to actually come to terms with the fact that, well, I can't afford a $1,200 iPhone. I have to afford this silly flip phone for $50. Like, people are going to have to make substitutions for what they want. Now, granted, we all kind of look at phones as a necessity, and a lot of places are requiring, a cell phone to even get their service. But if you look at like what's necessary, food's necessary, housing's necessary, probably electricity, unless you're living, by a campfire. So there's a lot of things that you're going to need. Those things are also going up in price, which means everything else you're going to have to make substitutions, meaning buy something cheaper than you're accustomed to. So instead of buying steak, you buy a hamburger or you buy Spam. Whatever it is in your budget, but you're going to need to find things that are cheaper, and that means people are going to spend less. In some cases, they're not going to buy it at all. So this is an important factor to look at because it's going to dictate the future of the economy. I think we're getting close to the end of what people can spend, which means a recession will come shortly thereafter. The number of realtors will move past that. So this is total debt balance. So I want to bring up this too, because this chart basically shows over the last 10 years or so, total debt balance. So there's non-housing and there's housing debt. So as you've noticed, housing debt has definitely gone up, but the non-housing debt's gone up more. So the spread between the two has gone up. And so there's going to come a reckoning at some point, whereas if we stay in this kind of environment and people can't, because I think what a lot of people are doing, and I don't know this for sure because the data, there's no data around this, but I suspect, just knowing people, is what they're doing is they're overspending and they're taking on more debt with the expectation that things will go back to quote unquote normal, which is what it's been like for the last 15 years, is what people think is normal. Well, that's not actually normal. That's normal in the context of recent history. But if you look at the last 100 years, it's not normal. We're not even close to normal. Normal is 40 to 60% lower here in the indexes. That's actually cheap. I shouldn't say that's normal. That's cheap. I would say like maybe 30% down is 30 to 40 is maybe normal. But if you look at like normal, people think it's just going to go back to that state. Well, what if it doesn't? Well, now there's a lot of people that are going to be screwed because what's effectively going to happen is they're going to run out of debt, and now they're going to have to stop spending, and then their whole life is going to cave in because they're going to say, well, I can't afford, private schools. I can't afford this nice car. I can't afford this nice house. I got to do all these things. Well, when people can stop affording a nice house, that means they're going to sell it. Well, I don't know if you've been following this show for any amount of time, but you know what our thoughts are about housing, which is it's going to go a lot lower, which means you're going to have to sell a lot lower, which means you're running out of equity. And so this inflationary spiral that's happened over the last 40 years is going to start to implode and start to shrink, which means that everything, asset prices, cash flows, income, everything is going to start to shrink. And that's going to cause a wealth destruction effect that people are not prepared for. And I'm not doing this to scare people. I'm doing it to impart a bit of wisdom of where things could go. I think there's a reasonable probability it could go in this direction. Now, it could certainly, the Fed could step in and say, we're just going to print money to infinity and we're just going to keep the party going, which case the outcome is going to be 10 times worse than what I'm talking about. But, Japan went through this, and Japan actually went through this reasonably. There's a lot of negative effects that happen because of it, but overall, like, they're still operating. If you have a recession, if you have these big problems, the world still spins. People still have jobs. They still go to work. These things, the world doesn't end. But what it means is that times get tougher for a lot more people. There's a lot of people with a lot of wealth, especially in my part of the country. Everybody here has money, but when things get tough, I think a lot of people aren't prepared for that. And that's a really important aspect. And I just want to leave it with this one chart, and then want to leave you with a few stats, and we'll wrap it up. So this last chart is the number of Russell 2000 companies that have been unprofitable. So if you look at, quote unquote normal times, it's like under 200. Now it's at 800. So for the last like 12, 13 years, it's gone from basically 250 up to 800, which means that just more companies are going public, and they're not profitable, but they're still public. And we've seen that, especially in the last few years, because it was cheap. There's cheap money, and everybody just cashed out. They said, hey, I can get cheap money. I can go IPO. People overpay for my stock, and I'm not making any money, but who cares? And people end up losing a lot of money. But I just want to point that out because I think it's just another piece of evidence that kind of wraps into this. I do want to leave you with a few more data points on real estate, and then I'll give it back to Doug to wrap it up. One is 70% of homes require a mortgage. So there are people who don't have a mortgage. And mostly they're older or inherited homes that have been paid off, but 70% of the homes require a mortgage, which means that mortgage rates are going to dictate a lot of real estate prices. Second thing to point out is median home prices went up 10% in the last year. You might think, well, how's that possible given all the stuff you said? I'm not saying it's not irrational. I'm just saying that if you look at the stats, median home prices went up 10% in the last year. While at the same time, real estate publicly traded REITs, the index is down 47%. So try to square that circle. One is measuring residential homes. The other is measuring residential homes. One's up 10%, one's down 47%. Why? Well, we could dictate there's a lot of reasons. 10%, that is illiquid. The public REITs are illiquid. So whether those real estate prices have changed or not, the investors in public markets have decided this is a bad place to be. Which side is right? Most likely the publicly traded side, because investors are looking ahead 6 months, while most owners of real estate are looking at today. They're not looking ahead 6 months or 12 months. The last point I wanted to make, which Doug alluded to, which is, home prices tend to trend. So if you look at real estate, it's a 15-year cycle typically. 15, 16. I think the last cycle was 16 years, but it's around 15 years is the real estate cycle. It takes about 5 to 6 years to go from top to bottom. And the recovery is about 10 years. So from the peak, which was pretty much last year, it's going to take 5 to 6 more years for real estate prices to bottom. And then it's going to take another 10 years to recover. So if you're not willing to wait 15 plus years to get the home price back that you think you can get, you should probably sell now. Now, I'm not suggesting you need to sell. I'm suggesting if you need to sell in the next few years, sell now, because you're not going to get a better price in the next few years based on everything that we're seeing. If anything, it's going to be lower, and you're basically just destroying equity. So just a tip of advice, if you own rental property, if you're on the edge, or if you have slim margins of making profit, get out and get back in later. I love real estate. There's no good or bad assets. There are only good or bad prices. So take that in mind. So Doug, let's take us home, wrap it up. Where can people find more about you, and what can you leave us with?
Well, I just wanted to say a couple quick points on what you were talking about before we jet off here. Number one, it's interesting that what you're mentioning about the Russell 2000, because the Russell 2000 is actually up year to date. So if that doesn't tell you that sometimes investors are just following the trend, things are moving. I mean, clearly the Russell 2000 has a tremendous challenge of profitability within it, but yet it's been one of the better shining points in the market year to date. So go figure. The second thing too, is you were talking about the credit cards and consumer spending and debt. It's a double whammy here, because if you are trying, we've seen a little bit of an increase in income because of inflation, but when you correlate that to the rest of prices that are happening in all of the other areas, even though you might be making a little bit more, you're starting to feel squeezed on those prices. Now add in the credit card debt that if you think, okay, I'm making a little more, I can try to get ahead and pay that down, and wham, they jack the interest rate on it 5%. So now your minimum payment goes up. So if you have credit card debt out there, it is critical that you work on getting that paid off as quickly as possible, because if these interest rates continue to remain high, if inflation continues to remain high, this could be, and now all of a sudden consumer discretionary spending continues to drop and squeeze, and debt is starting to go up, and you're putting more stuff on it. You could get into a perpetual cycle that only ends with one thing, and that's bankruptcy. And that is not good for anybody. So anyway, I wanted to, and of course the economy in general. So I wanted to tell you where to find a little bit more about me. Speaking of debt, speaking of expenses and costs and inflation, again, college is one of the worst culprits of this, and the prices keep going up, and the student loan percentages keep going up. And unfortunately, they've passed some things in the college world that are only going to give colleges more incentive to charge you even more, because the new rules around lending will minimize how much you have to pay on those loans, making it feel like someone with less income can afford egregious student loans. And that ultimately leads to colleges that will be happy to sell a $200,000 education to you for basket weaving, when in the end of the day, they know that you're going to be carrying this debt for multi-generational purposes. Now, even if you have the money to pay for college, nobody wants to pay more than they need to for college. They want their child to go to an extraordinary college, but they don't want to overpay, right? If you're out there and you don't want to overpay, go to procollegeplanners.com, and download our free checklist. You need to begin right there to understand that this is a game. The colleges have rigged this game against you. Doesn't matter if you have lots of money or if a little bit of money. Ultimately, they are in position to make you overpay. So start with that checklist, get some information, start to put things together to be able to start to even the playing field, because it's like tic-tac-toe, Kirk. Until you know the rules, you're always going to lose. Once you know the rules, you may not win, but at least you can put it on an even playing field and not overpay for college. It's a free report. Just go there, download it now, procollegeplanners.com.
Well, thanks again, Doug. And I think tic-tac-toe is a useless game. You can't win it. So I totally agree. I think what you're saying is really important, especially now. Colleges are going to keep going up in price, and you're not going to get more value to it. I think it was a few years ago, a few people said that you're actually getting a negative ROI in college now. So I don't know about basket weaving, but I prefer underwater basket weaving, Doug. I'm going to go to Florida.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.